Welcome to World Prism. Please subscribe and hit the bell icon for more breaking updates. In early 2026, Washington, D.C. was rocked by a stunning revelation that sent shockwaves through the corridors of power. The city, long accustomed to shaping global events, suddenly found itself blindsided by a dramatic shift in the international order. Years of U.S. sanctions on Venezuela, intended to pressure and isolate Maduro's government, had unexpectedly backfired. Instead of bringing Caracas to its knees, the sanctions had created new opportunities for America's rivals. While the U.S. aimed to cut Venezuela off from the world, China quietly stepped in, formalizing a massive $20 billion investment in Venezuela's crumbling oil sector. This deal was more than just a lifeline, it was a strategic partnership. This wasn't just about oil, it was a bold geopolitical move, signaling China's intent to become Venezuela's primary economic patron. The partnership sent a clear message: Beijing was ready to challenge U.S. influence in the Western Hemisphere. American intelligence agencies had underestimated both Venezuela's desperation and China's willingness to take bold risks for strategic gain. The scale and speed of the Chinese intervention caught Washington off guard. Suddenly, tanker data revealed Venezuelan oil exports to China had doubled almost overnight, with nearly 800,000 barrels a day now flowing east. The global oil market was shifting in real time. The U.S. policy of economic containment hadn't triggered collapse. Instead, it had pushed Venezuela straight into China's arms, forging a new axis in the global energy trade and redrawing the map of international alliances. For Washington, it was a rude awakening, one that forced policymakers to confront the limits of American power and the unpredictable consequences of economic warfare. The rules of the game had changed, and the stakes for global influence had never been higher. Venezuela, once an OPEC giant and the country with the world's largest proven oil reserves, was once the envy of the global energy market. Its oil fueled not only its own economy, but also played a crucial role in powering nations across the globe. But over the past decade, Venezuela's oil industry has been decimated by years of government mismanagement, corruption, and the crushing weight of U.S. sanctions. Once bustling refineries now stand silent, and the infrastructure that once symbolized prosperity has fallen into ruin. Sanctions cut off access to U.S. markets and froze billions in assets, crippling the state oil company PDVSA. Oil output, once the pride of the nation, plummeted to historic lows, sending shockwaves through the economy and leaving millions in poverty. As skilled workers fled the country in search of better opportunities, the remaining infrastructure decayed further. Venezuela was forced to sell its oil at steep discounts through shadowy intermediaries, often risking international legal battles and further isolation. The U.S. hoped this economic siege would force political change, but instead, it only deepened Venezuela's resolve to survive. The government began seeking new partners, forging alliances that would have been unthinkable just a few years earlier. The sanctions created a vicious cycle. Less production meant less revenue, and less revenue meant no repairs or investment. The industry spiraled downward, with each setback compounding the next. Venezuela was left sitting atop vast reserves it couldn't exploit or sell, until China arrived with both capital and technical expertise, offering a lifeline when few others would. The very pressure meant to break Venezuela instead opened the door for Beijing. China's entry fundamentally altered the region's geopolitical equation, shifting the balance of power in Latin America. China's intervention wasn't just a lifeline, it was a strategic pivot that would reshape Latin America's alliances, drawing Venezuela closer to Beijing and away from Washington's influence. The U.S. had underestimated the consequences of its own strategy, inadvertently accelerating China's rise as a dominant player in the region's energy sector. Now, Venezuela's oil industry stands at a crossroads, poised for a dramatic turnaround, but this time, it's on China's terms, not America's. As Venezuela's oil sector teetered on the brink of collapse, China saw a unique opportunity to expand its global energy footprint. While much of the world turned away from Venezuela's troubled oil industry, Beijing recognized the potential to secure a vital resource at a critical moment. Previously, Chinese oil companies had operated through a web of intermediaries to avoid U.S. sanctions, quietly moving barrels behind the scenes. But by late 2025, Beijing made a bold move and went all in, signaling a new era of direct engagement with Caracas. Energy security was the driving force behind this pivot. As the world's largest oil importer, China needed stable, long-term supplies to fuel its growing economy and maintain industrial momentum. By investing heavily when others fled, China secured vast volumes of Venezuelan crude at bargain prices. This not only ensured a steady flow of oil, but also gave Beijing significant leverage over global energy markets and future negotiations. This was about more than just economics. It was a direct challenge to U.S. dominance in the Western Hemisphere, reshaping the balance of power in the region and sending a clear message to Washington. PetroChina resumed direct shipments, and by late 2025, Chinese imports of Venezuelan oil soared to nearly 750,000 barrels per day, a dramatic increase that stunned global markets and analysts alike. The relationship was now open, formal, and massive. China was willing to absorb the political and economic risks for immense strategic rewards, cementing its influence in Latin America. The U.S. found itself increasingly sidelined, watching as China rewrote the rules of regional influence and established a new playbook for global energy alliances. The China-Venezuela oil pact was a lifeline for both nations. For Venezuela, $20 billion in Chinese investment meant repairing rigs, upgrading pipelines, and reviving PDVSA. China restructured Venezuela's massive debt, ensuring repayment through guaranteed oil flows. Chinese engineers brought modern technology and expertise, helping to rebuild Venezuela's depleted workforce. For China, the deal secured discounted oil and turned risky loans into valuable assets. The alliance stabilized Maduro's government, providing legitimacy and much-needed revenue. Social programs and public services revived, easing daily hardships for Venezuelans. The pact was more than business. It was a tool for political survival and a new model for global alliances. The impact was immediate. Oil exports surged, production climbed, and Venezuela's economy began to recover. Hyperinflation eased, the currency stabilized, and imports of essentials increased. Public sector salaries rose, and social programs were restored, bringing hope to a battered population. The oil sector's revival created jobs across industries, fueling a broader economic rebound. Yet, this recovery came at a price. Venezuela was now deeply dependent on China, its primary customer, creditor, and investor. Discounted oil sales meant Venezuela wasn't capturing full market value, but the alternative had been collapse. The country's future was now tied to Beijing's interests, limiting its options on the world stage. The economic revival was real, but so was the new dependency. The China-Venezuela alliance sent shockwaves through global energy markets. By absorbing nearly all of Venezuela's oil, China created a parallel supply system, bypassing U.S. financial and political pressure. U.S. Gulf Coast refineries, once reliant on Venezuelan crude, scrambled for alternatives, driving up prices for Canadian and Mexican oil. American refineries faced higher costs, squeezing profits and raising prices for consumers. The U.S. was now paying an economic price for its own foreign policy. Strategically, the alliance exposed the limits of sanctions in a multipolar world. China's willingness to buy from sanctioned states like Venezuela and Iran weakened Western economic leverage. The global oil market was no longer dominated by Washington. Beijing was now a rulemaker. The era of unipolar energy dominance was over. A new, contested order had arrived. The China-Venezuela oil alliance marks a turning point in energy geopolitics. U.S. refiners now face higher costs and tighter supplies, while China's model of supporting sanctioned states is spreading. Washington's sanctions policy has backfired, strengthening the bond between its rivals. The U.S. faces a choice: reassess its approach or risk further isolation as China builds a network of alternative economic partnerships. The world is dividing into competing blocs, each with its own supply chains and rules. The future is uncertain. Will this rivalry spark a new Cold War, or even a hot conflict? One thing is clear: American dominance over global energy is over. The world has entered a turbulent, unpredictable new chapter.